Okay, let's move on to the next standard in this chapter. So that's IFRS 13 on fair value. So what's the issue here? Many standards on their own already talk about how to treat their assets. And we already have kind of historical cost versus revaluation. But then we're having a range of new assets turning up, a new financial assets, a number of these instruments turning up, and we need to. Then we're having combinations, business combinations, and we need to think again about how we deal with the reporting of this and how to assess what the fair value of an asset really is. So someone says this is the fair value. The question here is, how did you arrive at this value? And so what IFRS 13 seeks to do is to create some kind of balance or some kind of structure for arriving at what fair value is. So the whole aim is to provide a single source of guidance for fair value measurement when it's required by reporting standard, if you like. So it's really for the standard to appeal to IFRS 13 to enable it arrive at a fair, if you like, expression of what a fair standard means. So IFRS 13 will improve comparability between many standards that require fair value measurement or fair value disclosures. And fair value fundamentally is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. So the argument here is we would argue that you have two people in the market willing to trade, and that would be considered, if you like, as long as they're not under duress in terms of this idea of it being an orderly transaction. And we sort of are happy with that. And of course, again, yes, in terms of fair value may be required to be measured on a recurring basis or non-recurring basis. The question here is that we need to find a way to get fair value, even though we're talking about things that don't happen very often, if you like. And IFRS 13, of course, establishes this kind of hierarchy. It puts them in levels. It sort of says, listen, level 1, this is your best form of best way to sort of trap or catch the meaning of fair value. It says, go in, you have an active market, people are trading in this market, there are lots of market participants, lots of market buyers and sellers in there. You can be sure that the equilibrium price you arrive at is a fair value for that product, because there are options, substitutes, if you like, of the same product, and so you are almost a price taker when it comes to level 1. So this is the best price, you would imagine, right? So this is, again, providing the most reliable evidence of fair value, and it's likely, of course, to be used without adjustment. So level 2 typically says, listen, okay, first of all, you don't have the product we're talking about doesn't get traded, if you like, itself that often, but we have similar products, if you like, that do. So for example, the example I'd like to use is, imagine you're trying to sell a small business, if you like, and they're in retail. So small businesses themselves might not get, I mean, there is a market for the trade of small businesses, but they won't be as busy as the shares, for example, of retail businesses on the stock market. So what they're really saying is, listen, we can reference the retail market and then sort of take a percentage. So for example, we'd typically say, what's the P over E ratio, say, for example, of the price over earnings ratio, for example, ASDA. Then you can say, listen, ASDA have a market share of, I don't know, whatever, 25%. And then you would look at your business and sort of say, listen, we have a market share of whatever. Say, for example, I don't know, 0.5%, and then sort of say, well, based on that, you could argue that our share or the value of our business is probably, I don't know, 0.6 or 60% of their P over E ratio of ASDA. Will take 60% or 50%, and then still sort of start from that point and then compare it maybe to your actual assets and liabilities, the net value of your business, and then compare it to other businesses in your area. So the key point is we have a reference point, really, is the issue here. So level 2 are observable inputs other than those included in level 1, which are observable directly or indirectly, which is where you see me referencing ASDA. This may include quoted prices for similar but not identical assets in active markets, or prices in inactive markets. So we're just really looking around because we don't have that same velocity, so to speak, in the level 1 market, in the level 2 market. So typically these require some degree of adjustment to arrive at fair value measurement. And level 3 really is that we don't have an active market for this, if you like. But what we can do is to kind of look at it internally, look at some sort of internal rate of return, and sort of say, well, what are the observable cash flows coming in over the next, over the life of this asset, and sort of work out a present value. Excuse me. Work out a present value, and therefore we can arrive, if you like, at a valuation of this. And this is, of course, the weakest form. It's really sort of saying we can't find anything actively to work with. And there you are. So those are the different levels. So we use fair value of law, of course, IAS 41, of course, a lot. We talk about it when we talk about investment property. If you remember when we talked about investment property, it's all held at fair value. Well, you have the choice to recognize it at cost, but that'd be unusual. Typically, it's all held at fair value and remeasured every single time. So you can see you do need, the only reason we can do that, holding it at fair value, is because we expect we recognize that the property market is a very active market, and so that's a recurring something that's happening often. Here we don't have that sort of with business combinations. We don't have businesses merging every single day, but we can still we're still required to do things. Of course, if you remember this, a lot of this is done fair value. We calculate goodwill on fair value. Our working to is based on fair value. So fair value is very much central to business combinations. Right. Again, here, the key point here is that we're trying to make sure we're fair. So you're trying to make sure that the right economic transfer has been done to whoever's the goods have been bought from, if you like. So it's really important to get that pricing right. Fair value. It's important to know what fair value is. We don't adjust it for the transaction costs. It's important to actually know what the fair value is, and that's the figure that should be used in the valuation. Okay, great stuff. So I'll do in this video too, I'll also deal with inventory. Nothing new. You guys must have definitely come up with seen IAS 2 in your time. Inventory is always lowered to the measure of cost and net realizable value. What probably is new is this idea of actually arriving at the cost. So typically think manufacturing. So you have purchase pricing. It's important to transport. All costs that bring a product to its use are considered to be made up of that cost. We do not accept abnormal costs. So for example, if you have made errors and made mistakes, you just expense those. You don't put them in the asset of inventory, right? You've paid for them, but they don't. So it's debit expense, but not debit the asset of inventory. Especially if you're making the product, right? This is production, right? So and that's really the key point here with inventory. And inventory, again, like I say, is always held at lower of cost, so that's what you're making it for. And then NRV, and NRV is what can you sell this thing for versus there might be some costs to sell or some costs to do some rework on it, if you like to do some amendments. So you take all those amendment costs and the cost to sell away from the selling price to get the NRV, yes, and compare that to the original cost that you already spent making it, and then you recognize the lower of that. Typically, of course, with production, we always, of course, include production overheads, of course, because ultimately we're really trying to find the standard cost, if you like, of making this. And of course, we might have work in progress. So it's all about, because of course, inventory is made up of 3 areas, isn't it? Raw materials, work in progress, and finished goods. So you want to make sure the finished goods, of course, have their own share of those production overheads. Okay, great stuff. Yeah, I think I'll end this video here, and I'll do my last video on agriculture.